Imagine a world where a single percentage change can ripple through the entire economy, affecting everything from your mortgage to your favorite tech stocks. Intrigued? Keep watching to uncover the power of interest rates. The interest rate is a percentage that a lender charges on the borrower's debt repayment, usually paid out over a specified period. When you take a loan from a bank, you'll be charged interest on the principal amount you borrowed. It's also the value that the bank pays individuals for saving their money with them, calculated over a specified period. There are many interest rates in any economy, and they differ between institutions. However, the most important interest rate is set by central banks, and it affects all others. When central banks raise or lower interest rates, the cost of borrowing charged by the banks to businesses, homeowners, and consumers also increases or decreases. In 2022, the US Fed raised the interest rate by 0.25 percentage points, from 0.5% to 0.75%, impacting various other interest rates imposed by commercial banks. Prime rate: this is the rate at which banks charge their best clients with a good record of repayment. Credit rate: the interest rate levied on risky customers with a fair or subpar credit rating that want to borrow money. Mortgage rate: the rate at which mortgage is charged over a specified term. Central banks change the interest rate to control the rise of inflation. When inflation is too high, the central bank raises its interest rate to slow down spending. Conversely, they lower the rate to stimulate the economy and increase spending, thereby promoting economic activity and growth. Interest rates and stocks tend to move in opposite directions. Stock markets react quickly to interest rate changes because it affects stock investors' expectations about future stock performance. Once the central bank increases the interest rate, banks will charge consumers more for credit, weakening their spending power. Public companies are not exempt from the effects of increased interest rates. There will be a higher cost of borrowing for business, including higher payments on current debt. Growth stocks typically underperform relative to value stocks in high interest rate environments. Growth stocks are burgeoning companies expected to grow and outperform the market. When the central bank hikes interest rates, it becomes less attractive for investors to back growth stocks because they'll have less money in the business. Value stocks, by contrast, are stocks of well-established companies that pay stable and regular dividends. These companies enjoy continued demand even during times when people spend less. The relationship between interest rates and bonds follows an inverse pattern. As interest rates rise, bond prices fall. You can speculate on the future direction of interest rates in the short term using leveraged derivatives like CFDs. You can go long or short to hedge against other investments. Unlock the secrets of the financial world and stay ahead of the curve. Remember, knowledge is power. Keep learning, keep growing. If you like to keep learning, please subscribe to this channel.